International Tax Director at Armanino. I'm joined by Rajiv and Sunil from ASA Associates, our affiliate CPA firm in India, and they will be discussing today the digital tax that has been implemented in India effective April 1, 2020. And Rajiv and Sunil, please introduce yourselves.
Thank you, Marcus. Thank you for introducing us. Allow me just to quickly summarize what I've done and what experience that I carry. So I am the tax partner based in New Delhi and also operate out of the Mumbai office with our firm ASA Associates. I've been practicing international tax for the last 20 years, and my area of specialization in the international tax side is a lot of corporate advisory that we do on permanent establishments and, for example, issues that we're going to discuss on the equalization levy. So that's myself. Marcus, I know you've been writing blogs about this new law, and that perhaps sets the tone for this entire discussion today. You know, as you all know, digital tax has been growing at the speed of light. I'm sure that's not wrong to say. And this is perhaps the first subject internationally where the businesses have outpaced the regulators. So regulators have been trying to figure out a way to tax this business, but you know, they certainly have been left behind. And why I say this is because you know, digital transactions have been in focus for since the 90s. But somehow, and given the way OECD has dealt with this particular subject, it is only in 2013 that OECD took a very concrete step by coming out with a specific report to deal with this particular subject. And that has started creating awareness about this subject. So what is happening is that until the time OECD did deliberate on this issue, and until the time OECD has a very definite direction to this particular subject, countries have been trying to do unilateral measures to tax this sort of an income in their territories. And this obviously causes multiple issues, multiple debates. When you take a unilateral action, it obviously leads to repercussions, consequences. You would have seen countries around the world have taken different sort of approaches towards taxing digital income. Keep in focus, countries like France. US has had its fair share of debate with France. Other countries, Austria, Australia, they've all started debating. They've all started discussing what's going to happen. Now, until the OECD comes up with a final paper and a final approach, which they recommend as a definite approach to arrive at a fair and equitable way of taxing digital income, these issues will remain, in focus. And mind you, this discussion today is this will show you a picture of how the world is dealing with this tax. India is not unique in this entire process. Everybody is trying to secure their fair share of revenues. So India is not alone in this whole discussion. And so this discussion is going to tell you how the world is also going to deal with this problem. So what we decided to do today was we said that maybe it's high time that we try and provide an overview of this particular legislation. India has done quite a bit in the last 5 years, and it's imperative that we discuss, specifically given the fact that the countries affected, given their global digital presence, is primarily the US, and therefore investments coming out of the US may be subjected to, in the digital space, may be subjected to this tax. What we've done is we have sort of touched upon a similar legislation on equalization levy, which was introduced in 2016, and the new levy, which has been introduced in 2020. And there's a link between the two, and I will try and explain that to you. This new law has created a lot of ripples across industries, and I will tell you what's the reason behind that. But that is important to understand where are we heading, and that should give you an overall sort of picture as to what India wants to do, how India wants to go about it. So what is the problem? What is the dilemma that we face when you look at digital incomes? when you talk about digital income, let's say a typical income, a transaction done by Amazon, what is happening is that there is a clear nexus with a particular economic jurisdiction, but there is no physical presence. Now, tax regulators around the world, they have not known, they don't know how to tax any income where they can't find a basis to which they can attribute income. So the source country, let's say in this case, India, doesn't know how to tax it simply because there is no physical presence. Again, the issue is when you are earning income from India, what kind of income is this? This is an income by way of a digital interface. Does this constitute royalty? Does this constitute fee for technical services? Or is this a P-related business income? How do we know that? It's very difficult to determine. Another issue that we face is that there is no understanding, there is no recognition on how to attribute values to the source of income that gets generated. Last but not the least, you're talking about a digital platform. You're dealing with IPs. You're not dealing with people. You're dealing with digital IPs. How do you trace digital IPs? Which countries are prepared with an infrastructure that caters to this requirement or not? All across the world, even the more developed economies do not have this ecosystem which can do this tracing very well. And this is becoming a big issue in the new law. This, in a way, obviously creates a lot of issue for, the digital income does not give you a fair and equitable basis as of now. And therefore, it is very critical for the world over to come on a consensus which gives you a fair and equitable basis to tax digital business models. This is a typical problem. Next slide, please. Now, what is the Indian jurisprudence? We have had courts ruling on similar subjects. So the courts have dealt with subscription models. The courts have dealt with internet advertising. The courts have dealt with web hosting services. What is the result? The result is not clear. The courts have dealt with these problems on a fact basis. And obviously, there have been different and divergent views. So some would say, for example, subscription models are taxed as royalties. When you talk about advertising, internet advertising, again, it has remained largely untaxed because advertising primarily involves no services. It is business income. Unless you have a P in India, permanent establishment, you cannot tax that. Web hosting, similar cases. So what the courts have done is, the courts have looked at a fact-based approach, and there is obviously no consensus. In any case, there are no definite rules that we are referring to, that the courts are referring to, and therefore, this is going to be the problem. Next slide, please. So what has India done? India has made a lot of progress, and how, last 4 or 5 years have been revolutionary in the way India has dealt with this problem. Good, bad, ugly, I'm not commenting upon that, but India has made progress. So 2013, the discussion started essentially 2015. The BEPS committee came out with Action Plan 1, which dealt with addressing the taxation issues of digital economy. Now, India took cue from the BEPS report, and in 2016, India set up a specific committee to deal with the digital taxes. And this committee evaluated all the options that were given by the BEPS committee. And they said, to begin with, we can start with an equalization levy of 6% on online advertising and related activities. Now, why only online advertising and activities? Because it was a simple concept. Online advertising 5 years ago was the single largest source of digital companies, and this was going untaxed. And given that the government has always wanted to create a level playing field with Indian digital businesses, this was not being addressed. So the government said, we're going to levy a 6% tax on online advertising, and that was done in 2016. At that very moment, we were given an indication that the scope of this tax could be expanded in the times to come. Now, in the meanwhile, the government started working along with the BEPS committee, along with the OECD. The government started working on rules dealing with the significant economic presence, SEP rules. So in 2018, we came out with a set of rules, but then we said the OECD is not ready. There are no final guidelines internationally. There will be problems. There will be debate. We said we're going to defer it. As of now, it's deferred, but SEP is something we must discuss at the end of this discussion. 2020, today, what happened in this year? India took two major steps. One is a step which is applicable, in India. We're talking about a withholding tax transaction, but withholding tax is generally tax neutral because you get credits. The other part is the 2% tax, which Marcus mentioned in the beginning of this discussion. And we're talking about this 2% tax. This is the second avatar of equalization levy, wherein the regulators have captured non-resident e-commerce operators. Now, the OECD, when they gave the suggestions to different economies that even when you take a unilateral step and you were to introduce your own taxes, please keep in mind that you have to honor your tax treaties, that you don't discriminate. This tax, unfortunately, has taken a different view altogether, taken a different direction altogether. I'm going to discuss that now. Next slide, please. So the levy 1.0, equalization levy, EQL 1.0, that we call as the stepping stone. India created a basis, an ecosystem of levying equalization tax. Not much debates were held when this tax was introduced because it was pretty straightforward. In 2016, a 6% tax was applied on online advertising, only on the B2B component, not on the B2C component. So if you are paying to an online advertiser, you are an individual, you are not using this for your business, there is the equalization levy 1.0 at 6% does not apply. Now, importantly, what is the collection mechanism in this whole process? Collection mechanism is that the service receiver, the B2B, the business in India, is going to collect and pay, and that is the final tax liability, no debate. The threshold was very small, very minor, just about $1,300 US. And any provision of equalization levy very clearly says that the moment you are taxed in India as a permanent establishment, you are taxed as a foreign business, and equalization levy does not apply. This has been a consistent principle India has applied. Now, equalization levy 1.0 was the first example India ever acted unilaterally, right? We had our fair share of debate in 2012 when India changed the act, the provisions of the law retroactively, but that was then, this is now. Deliberately, this tax 1.0 was kept outside the purview of the normal tax law. This was a part of the finance legislation, but not a part of the tax legislation. And the purpose was perhaps to create a distinction between this tax and the corporate tax. And as a result, whatever you pay as equalization levy in India is not creditable under the tax treaty. Right. Next slide, please. 2.0, we call it. This is indeed really a big leap forward. India has taken a big step. Now, India realized over the period of last 5 years, SEP was not working for India. India realized that online advertising alone was not the largest source of income for global digital companies. Digital business, on the other hand, was going hand in hand, specifically the e-commerce part. This was going hand in hand with the Indian brick and mortar businesses. So India said they wanted to create a level playing field for both. Now, on one hand, the Indian brick and mortar pay taxes. The e-commerce digital businesses who have an equal amount of share now in the economy, or slightly less, but very significant share, were not getting taxed. There was obviously, in the eyes of Indian regulators, a need to levy this tax. Now, the biggest surprise and why this levy has gone awry, is the fact that this was a wildcard entry. Generally, the way India introduces taxes is that they will issue by way of a memorandum. They will introduce the law in the form of a bill, a discussion paper to the parliament. The parliament will debate. Stakeholders will comment. And stakeholders would include consultants, economists, businesses at large. Now, this tax, when this was introduced, had nothing of this sort. It just came like wildfire. Nobody knew when it came. The moment when the bill was turned into law, at the end of March, it came as a surprise note. And that's where the surprise element was a bigger a problem for businesses, because they were not prepared to deal with this particular situation, and not the tax alone. Tax alone may be different issues, but the surprise element was also a big shocker. Now, this is a 2% tax, applies on a non-resident e-commerce operator. And mind you, these terminologies are going to be very critical, so I'm going to discuss these terminologies slowly. Now, who should pay? A non-resident. In EQL 1.0, it was the service recipient who were responsible to pay. That's not the case here. It's the service provider or the e-commerce operator who is liable to pay. And there are some threshold. Threshold is not very significant from a US perspective, but it's still significant from an Indian perspective. Everything else remains the same as it was in EQL 1.0. Now, who is an e-commerce operator? E-commerce operator must be a non-resident, that's the prerequisite, who owns, operates, and manages a digital or electronic facility or a platform for online sale of goods or provision of services or both. The focus is the transaction and the fact that a digital electronic facility or platform for online sale should be present. That's the takeaway from this definition. Next slide, please. Now, this, as Marcus said in the beginning, this tax applies on gross consideration. But how do you derive this gross consideration? First point, it's a B2B and a B2C aggregate. And what do you put together? You put together online sale of goods, online sale of services, not only provided by the e-commerce operator, even if they are facilitated by the e-commerce operator, it is included in my gross consideration. And I know you're getting a hang of the issues that may be emerging, or any combination of all of this. This is something which is something we must bear in mind. Next slide, please. What is e-commerce supplies of services? Now, this is the most critical part of this discussion and the most debatable of all. Any supplies that you make to an Indian resident. So I'm an Indian resident. If I buy something from a non-resident digital e-commerce platform, the sale made to me must be counted. Any person, resident, non-resident in India, if he uses an IP located in India, Internet Protocol located in India, he is also covered. And it doesn't matter whether the person is resident or non-resident. Similarly, it doesn't matter whether the Indian resident is in India or outside India. And we also don't know right now whether the Indian resident, are we talking about residents as per the Indian income tax law, or are we talking about the resident as per treaty? I don't know. It's vague. It's in thin air. The third part is all the more important. We're talking about sale by a non-resident e-commerce operator to another non-resident. This is the most critical part. Towards sale of advertisement, an advertisement which targets an Indian resident or an IP located in India. Similarly, with sale of data. Now, it's anybody's guess. How do you define the terminology target? I don't know. It's very difficult to fathom at this stage. It's an open-ended discussion, and I can debate about it the whole day. Next slide, please. So obviously, when you talk about it, there are tons and tons of open issues. If I was to write a book about it, I think 98 pages of 100 will be about open issues. There are just so many. And I've just given you a glimpse of what these look like. And I can break it down into a number of issues. So look at something like, I spoke about target. So there is obviously a challenge in identifying advertisement that target an Indian resident. What defines that it is being targeted to an Indian? Is it aimed at Indian community? Is it aimed at products that the Indians use? I don't know how. What is the target? How do you distinguish between a resident and a non-resident Indian through an electronic platform? I am behind the curtain. I am on a computer. How do you define my residence? That's the most berserk argument I would ever understand. What about the post-supply events? I am trying to define on what amount I have to pay the 2%. But What about the post supply? What is the trigger? What is the trigger point when EQL applies? Is it when the sale is made? And if yes, when the sale is made, what happens to the sales returns, right? What happens to the sales return? What happens to credit notes, bad debts? I don't know. How do you define the character of this income? Is it leading to double taxation? For example, look at it from two perspectives. I am the e-commerce operator. I want to classify my sale as subjected to EQL at 2%. The customer says, no, I think in my opinion, it's royalty income. And therefore, I'm going to deduct a 10% tax. This 10% tax may be available to me as a credit, but for cash flow purposes, I'm going to be suffering a 10% and a 2%, and the 2% is not going to come back. So it's a vicious circle. Talk about IP addresses. How do you track IP addresses? What if I'm not using a private computer, I'm using a VPN? I get shielded. How do you know it was made to an Indian resident or not? So therefore, the problem, how do you track these transactions at the first place? What if it's being undertaken by bots? These are all practical problems. All of us use this simple technology today, but governments, how empowered, let's talk about Indian government, how empowered is the Indian government to sort of take stock of these issues? If I go wrong, I'm subjected to penalties, even jail proceedings. But how will the Indian government verify this? I don't know. Next slide, please. Next slide. So what is the fine print? I'm just going to go quickly. We just have 5-7 minutes. What is the fine print in this entire discussion? Now, equalization levy 2.0 and 2.1 both, they are not a tax on income. That's very clear. It is a tax on gross consideration, value of sales and supplies. Now, other part is EQL. Both 1.0 and 2.0 is full and final tax. That means if you are subjected to EQL, then you cannot be subjected to corporate taxes. The law specifically exempts any income subjected to EQL from corporate taxes. There could, although, be an issue where there could be two interpretations. I give you an example where the customer may think otherwise, and therefore it's not sacrosanct. What about the credit of EQL? It is not a part of the Indian income tax law, and therefore credit may not be available. Also, if you paid this tax wrongly or you paid excess tax, we don't know today if you can get refund or not. Another important point, you are going to be dealing with IP addresses. You're going to be putting additional staff to collect data for yourself. What if you were to report a wrong number or wrong information to the Indian government? They haven't yet released the set of format which they need from you. They've only released a challan for tax payment. But if you do falsify your data, assuming that the Indian government has no resources to correct it, you could invite a jail proceeding by the Indian government, and they become very strict nowadays. And now the other part is, besides equalization levy, there is an indirect tax in India. Let's call it VAT, Indian VAT, which is under a new regulation called OIDAR. And under the OIDAR regulation, it is an 18% tax. But the good news is, it is in the hands of the service receiver, and therefore, in terms of the tax service provider, it is always a tax neutral situation. So you don't have to worry about the cost here, but there may be situations where you may have to worry about the compliances. Next slide, please. So this is how we look at, I think we thought about the whole concept, and we said that this concept could easily apply to these many models. So talk about subscription models. We're talking about OTT platforms, e-learning platforms, online gaming, ebooks, music, data storage. When you talk about payment intermediaries, you talk about companies like MasterCard. In fact, just to share a very recent news with you, MasterCard very recently have approached the one Indian court, saying that they already have a permanent establishment in India, and they have been asked to pay equalization levy. And the golden rule is, if you have a PE, you cannot be asked to pay an equalization levy. But again, the silver lining is, when they say if you have a PE, they're only talking about a fixed place PE. They're not talking about a service PE or a supervisory PE. So we don't know the details of the case right now, but this is already being challenged. Talk about e-commerce marketplaces. You have Amazon, You have the Facebook marketplace today. You have aggregators, you have social network platforms, so on and so forth. Now, in order to comply, what do you need to know? You need to know how do you examine your particular case to this situation. Give me the next slide, please. This is what we would suggest, and this will give you a stepwise approach, very straightforward, crystal clear. Step one, obviously, you will check the initial parameters. What is your residential status? There is a new regulation in India called the POEM regulation, Place of Effective Management, which could make you a resident in India. So, and this law only applies to non-residents. So you have to check your residential status. You have to check your P status. Are you a fixed base P in India or not? And obviously, to check the threshold, you check the quantum. Then you move to step two. You're checking the coverage. Are you an e-commerce operator, as strictly as to the definition here? If you are, whether your transactions qualify to be e-commerce supply or services. We've discussed this in the definition, and we are going step by step. And then the moment you know, you get a yes to step 1, 2, and 3, you move to step 4, and then you start classifying your supplies. And I gave you this bizarre way of classifying. You have to look at Indian residents, Indian IP, and non-resident to non-resident transactions. The moment you're confirmed that you're there and you have a tax liability to pay, you will register with tax authorities. You will determine your aggregate value of sales and pay within 7 days of each quarter. So you don't have to pay monthly, you pay each quarter. And then obviously every year by a specific timelines, you will submit your tax returns. My last slide, please. So what is the way forward? I think I've said a lot about it. India is very serious. In fact, just a couple of days ago, there was a press release where the Minister of Finance very clearly said that we are very clear about the levy of equalization levy, and there will be no more clarifications whether this would apply to this or that situation. Now, she said that, but the industry has created tremendous pressure, and we do hope that there will be some clarification. There better be some clarification. Otherwise, there's going to be a problem. So I certainly, I can very easily say, and this is a very, very clear understanding, that this is not a tax which ensures a fair and equitable solution to taxing digital services. The current Avatar 2.0 is very ambiguous and will give rise to litigation. I've already told you about the MasterCard case. Now, the silver lining is India has already said they're going to apply the SEP rules in 2021. I don't know if it happened in 21 or 22 due to COVID, but India has said so. Now, somewhere the SEP rules and the EQL scope converge with each other. So what should naturally happen is the moment SEP is applied, EQL should lose shine. And for that purpose, it should subsume into SEP. And for that purpose, we would imagine that EQL could at best be a tax which you will see for the next 2 years, not more than that. This is our best guesstimate, and this is how we read the signals, the directions coming from the government. But for now, it's here to stay. It's here to stay. Depending upon what you have at stake, you must evaluate what options do you have. Already given you a stepwise approach of how you can evaluate. But remember, the Indian tax system also gives you a window where you can approach them, and this is a high cost option. It takes a lot of time, but there is a window available where you can approach the Indian regulators and ask for a specific ruling whether you are exempt whether you are covered under the Indian Income Tax Act or the equalization levy, and that should give you sort of a final answer, and which will help you take a particular decision. That we can move to the next slide, please. That brings me to the end of my discussion. Marcus, over to you.
Yeah, thank you very much for your presentation, both Sunil and Rajiv. Are there any questions by anyone? I guess with that, thank you very much, Rajiv, and thank you very much, Sunil, for your assistance. And I believe that concludes our presentation. Thank you very much.
Thank you. Bye-bye.